Welcome, curious minds. You've sent us, quite a stack of sources, actually. And today, we're taking a deep dive into something that could really fundamentally change how you think about investment decisions. It's called real options.
That's right.
We're all pretty used to hearing about net present value, right?
Yeah.
NPV. It's usually seen as the kind of gold standard for appraising projects.
The go-to metric, yeah.
Exactly. But what if that whole traditional approach is systematically, missing huge amounts of value, millions, maybe even billions, just by ignoring the power of having choices?
Well, that's what's so fascinating here. Conventional NPV, it just assumes a project starts like right now and follows this fixed, pre-decided path. It's very much a now or never kind of decision.
Right, no wiggle room.
Exactly. It completely overlooks the real-world flexibility managers have, the strategic choices. So this deep dive, we're going to explore how this real options idea addresses exactly that. It tries to estimate the actual quantifiable value of that flexibility.
Okay, so what does this actually mean for you listening? Well, I think it means we're going to uncover how uncertainty, which we usually just see as risk, something to manage.
Right, something to minimize.
Yeah, how it can actually be an opportunity to exploit. We'll look at how valuing flexibility can lead to, frankly, much more accurate project assessments. And maybe prevent organizations from underinvesting in really valuable opportunities.
We'll definitely look at specific scenarios where these real options tend to pop up. Things like the choice to delay a project, maybe abandon it if things go south, or even pursue, future opportunities that only exist because of an initial project.
Okay.
And we'll also need to touch on the tool often used for the Black-Scholes option pricing model. We'll talk about its variables, but also importantly, its limitations. You really need to keep those in mind.
Yeah.
So get ready to see how choices that seem small can actually hold significant, measurable value, sometimes turning what looks like a no-go project into a definite yes.
So if traditional NPV is like having this fixed battle plan drawn up from day one, let's really unpack how real options allows for, strategic pivots, changing tactics when you get new information. How does that rigid plan you mentioned, how does it typically fall short?
Yeah, that's a really crucial distinction. Conventional NPV, it sort of bakes all the risks and uncertainties into the discount rate, the cost of capital, or maybe you do some sensitivity analysis around it.
Right.
But real options thinking views these uncertainties differently, not just as risks, but as potential upside opportunities. It lets an organization exploit good outcomes while having the choice, the option to just walk away from bad ones. It explicitly considers the time you have before you absolutely must make a decision and the inherent risks you can actually leverage.
Okay, so it's really about seeing value in the choice itself, the flexibility. Our sources seem to point to three main types of real options that come up a lot in investment appraisals. The first one is the option to delay a decision, put it off.
That's right. And this is typically what we call a call option. It's essentially the right, but crucially, not the obligation to buy into something later on.
Okay, so one source gives this example. A company's considering bidding for exclusive rights to some project. Initial cost, $35 million. Now, without any option to delay, the project's NPV is calculated at, let's say, $5.8 million. Modest? Maybe okay. However, if the company can actually wait 2 years before committing that $35 million, the value of just having that flexibility, that 2-year delay option calculated using Black-Scholes, jumps to an incredible $9.56 million.
Yeah, just for the option to wait.
Exactly. That's a huge potential increase in value simply because you have the choice to delay and react to whatever happens in those 2 years. New information comes in, you can use it.
Okay, now this next one, this really starts to show the power, I think. The second type, the option to exploit follow-on opportunities. This is also a call option, right? Where doing one project kind of opens the door to future ones.
Precisely. Think about a project with, say, a small positive NPV, maybe $3 million. On its own, you might think, it's okay, but not amazing.
Barely worth the effort, maybe. Maybe. But what if that project helps develop a technology that enables a much, much larger second project, say 4 years down the line? Now, this second project, if you look at it today with conventional NPV, might look financially unattractive. Maybe estimated costs are $140 million, but the present value of its expected cash flows is only $90 million.
So standard NPV would just scream, no, run away.
Absolutely. It looks like a money loser on paper right now.
But That's where the real option calculation changes things, doesn't it? It sees something NPV misses.
It totally does. If you factor in the option to pursue that second project in 4 years' time, remember, it's just an option, not a commitment. Yet the value just attributable to that option is calculated at a staggering $20.85 million.
$20 million, just for the potential.
Just for the potential, yes. So when you look at both projects together, the overall value isn't just the initial $3 million. It's $3 million plus $20.85 million, so $23.85 million total. It stops the company from perhaps mistakenly rejecting the first project and missing out on huge future gains just because that follow-on part looks negative today.
Yeah.
The flexibility to wait, see what happens with volatility over those 4 years adds enormous value.
That's fascinating. And the third type is the option to abandon a project. This one feels a bit counterintuitive, maybe, because it's about walking away, but there's value in having that escape hatch, like buying insurance for your business moves.
That's a great analogy, actually. You hope you don't need it, but knowing it's there changes the calculation.
Right.
It absolutely is. And this is a put option, so the right to sell or walk away, which basically limits your downside risk.
Okay.
So our source describes this company, Duckco, considering a 5-year project. Initial cost, $37.5 million. Now, the calculated NPV without considering any options is actually negative. It's about minus $450,700.
So definitely a no-go in traditional terms.
Absolutely. Based on that number alone, the company would likely shelve the project.
Okay, wait a minute. So a project that looks like a complete bust on paper, negative NPV, it can actually become a winner just by valuing the option to ditch it later. That almost sounds too good to be true. I mean, how often do companies really get to just walk away cleanly like that?
Well, it certainly sounds counterintuitive, I get that. But the value lies in having the choice. And the example shows that even if the option isn't ultimately exercised, its mere existence can change the upfront decision.
Oh, so.
So in this case, another company, Swanco, offers to buy the entire project from Duckco for $28 million, but only at the start of year 3. Okay? So even though Duckco doesn't get cash right away, this offer represents an abandonment option. They know they can sell out for $28 million in year 3.
Oh, okay. A guaranteed exit price.
Exactly. And the finance director assesses the project as having high volatility, a standard deviation of 35%. High volatility actually increases the value of options. So the Black-Scholes model calculates this put option, this abandonment option, as being worth $3.45 million.
Okay.
So when you add that $3.45 million option value to the initial negative NPV of Medisho $450,700. The project's overall NTV becomes positive, around $3 million positive.
Wow.
Which means you might actually take on the project knowing you have this strong backup plan, this contingent exit strategy, if things start to look bad down the line.
That is a huge shift in perspective. A project that looked like a clear loser becomes viable, maybe even attractive, just because you factored in the value of being able to cut your losses.
It really is. Now, when we talk about actually using the Black-Scholes model, or BSOP as it's often called, it relies on 5 key variables, 5 inputs.
Okay, what are they?
Right, so you have the underlying asset value that's basically the present value of the future cash flows you expect from the project itself. Then there's the exercise price, that's the cost to actually exercise the option, like the $35 million investment or the $140 million for the follow-on project.
Got it. Asset value, exercise price.
Then you need the risk-free rate of return, like government bond yields. Then, critically, the volatility or the riskiness of the project's value, often measured by standard deviation. And finally, the time you have until the option expires, the 2 years to delay, the 4 years for the follow-on project, etc.
Those 5 things: asset value, exercise price, risk-free rate, volatility, and time.
Those are the main ingredients, yeah. They go into the formula to calculate that option value we've been talking about.
But, I mean, it's not a perfect crystal ball, is it? Surely there are limitations when you apply a model designed for, like, financial stocks and bonds to real-world physical investments, big, messy projects.
Oh, absolutely. That's a really critical point to understand. The standard BSOP model assumes these options are what they call European style.
European style. What does that mean?
It just means they can only be exercised right on the expiry date, not before. But in reality, most real options, delaying, abandoning, expanding, they're more like American-style options.
Yeah. Meaning
you can usually exercise them anytime up to the expiry date, not just on that single day. You might want to abandon ship early, for instance.
Okay. So the model doesn't quite match reality there.
Exactly. And that difference is important because it means Black-Scholes, by its very structure, tends to slightly underestimate the true value of real-world options because it doesn't capture the value of being able to exercise early if conditions change favorably or unfavorably.
Right. And estimating that volatility number for these big, unique projects, that must be a huge challenge, right? There's probably no historical trading data like there is for a stock. It sounds like you're almost trying to put a precise number on something that's inherently a bit fuzzy sometimes.
You're absolutely spot on. Unlike, IBM stock where you have decades of price data, these real options are often for one-off, unique strategic projects. Historical data for volatility, usually scarce or non-existent.
So what do? Guess?
Well, not quite guess. It often requires using more complex simulation techniques like Monte Carlo simulation, which basically involves running, thousands, maybe tens of thousands of what-if scenarios on a computer to try and estimate the range of future possibilities and derive a volatility estimate from that.
Okay, so it's possible but complex.
It's possible, but it's complex, and those simulations themselves still need accurate models and reliable data inputs to be meaningful. Garbage in, garbage out still applies.
Sure. What other sort of assumptions does the Black-Scholes model rely on that maybe don't hold up perfectly in the messy real world?
Well, yeah, it does lean on some pretty strong theoretical assumptions that don't always quite fit the gritty reality of business. Things like assuming perfect information flows or assuming key factors like interest rates or even the project's underlying risk levels stay perfectly constant over the entire life of the auction, which,
isn't very likely.
Not often, no. And crucially, the basic model doesn't really account for the sort of human element, like the unpredictable decisions or potential biases of the managers themselves, or even just straightforward counterparty risk, the risk that someone involved simply doesn't fulfill their end of a deal, like that offer to buy the project in the abandonment example.
Right. The model assumes a perfect, predictable world in some ways.
In some ways, yes. So the number it spits out, the option value, it's probably best seen as an indicative value, not a definitive, precisely correct number carved in stone.
Okay, indicative.
Yeah.
But you're saying even an indicative value, acknowledging the flexibility, is still much better than just ignoring it completely like traditional NPV does.
Precisely. Estimating and adding the value of these embedded real options, even with all these caveats and limitations we've discussed, it still generally provides a far more accurate, more holistic assessment of a project's true potential value.
Right.
And importantly, it significantly reduces that tendency for organizations to underinvest, to walk away from potentially really valuable opportunities just because the initial static NPV calculation looks borderline or negative. It really makes you wonder, doesn't it? How many potentially great projects might have been dismissed prematurely over the years using just the old way of thinking?
Yeah, absolutely. So, okay, wrapping this up. What does this all really mean? We've seen how bringing this real options thinking into the mix alongside conventional NPV, it fundamentally changes the picture.
It really does.
It moves us beyond that rigid now or never mindset. It assigns a tangible monetary value to flexibility, to having choices in investment decisions.
And if we connect that to the bigger picture, yes, the Black-Scholes model gives us an indicative value, not a perfectly correct one, partly because of its assumptions, partly because real options are usually American style, not European. But even so,
it's still better.
It's still offering a more accurate assessment, generally speaking, of a project's true overall value. And that, as we said, can really help reduce that damaging propensity for companies to underinvest in good, but perhaps initially uncertain opportunities.
Just think about that for a second. A project that looks like, well, a losing bet on paper, a negative NPV, can actually become highly attractive once you properly factor in the value of that flexibility, like the option to bail out if things go really wrong.
The abandonment put option, yeah.
Or the potential for really lucrative follow-on projects down the road. It's really about seeing potential opportunity hidden within uncertainty rather than just risk.
Which really raises an important question, I think, for you to consider. How might really understanding real options change the way managers approach strategic decisions in the real world, going beyond just that initial financial number crunching? If flexibility itself has a calculable value, even an indicative one, how might that influence the very design of projects, the timing of decisions, maybe even encourage building in more flexibility from the outset? Something to think about.